morning, my YouTube family. Welcome to yet another episode of Immigrant Millionaires. So, guys, as we had discussed in our last one or two videos, the objective behind creating this channel, why are we here, what is my background, and what are certain things that I'm going to cover in the next series, upcoming videos. So, this video, as requested by some of you, is dedicated to investments. Friends, if you've already subscribed to this channel, thank you very much. If not, please consider subscribing because on this channel, we're going to share a plethora of knowledge about wealth creation, the different tools for that, different strategies. So please consider subscribing and let me know in your comments what else do you want to learn in the next videos. Thank you very much. Some of you is dedicated to investments. As you know, this channel is where we are going to discuss about everything money. And when it comes to money, I'm not talking about right now about saving money, being frugal, saving pennies here and there. No, we are talking about building wealth because that's where my expertise is, and that's what I would like to share with you all. So when it comes to increasing your wealth, the main form of increasing your wealth is not saving, it is mainly investments. And when you talk about investments, right, even though there are many ways that you can invest your money, the two key ways to invest money in any form would be your real estate investments and your stock market investments. Now, when it comes to real estate, right, we'll talk in detail about it in upcoming videos. But basically, people are comfortable when it comes to real estate because they believe that they are holding a physical piece of land, right, which provides them comfort. When it comes to stock market investing, they feel that it's all on paper. They don't hold money as such. So people are uncomfortable, especially when it comes to investing in individual stocks. You would have heard from your friends and family, at least I have done so, heard from a lot of friends and family that, I invested in so and so stock and it went down and then I lost 20%, 30%, and then I came out of that. I went, invested in certain mutual fund, and then I lost my money, and then I came out. I mean, I used to, I grew up listening all these stories, which is why in the beginning I was very wary. But see, you are fearful, wary of something unless you understand the fundamentals. And once you understand the fundamentals, right, that's what gives you confidence, comfort in moving ahead. So if you say that, no, I'm not comfortable investing in stock market, then understand this. You are keeping one of the key ways of growing your wealth out of your purview, which I don't think so you should be doing. The thing that you should be doing is if you're not comfortable, educate yourself, make yourself aware, watch more videos like this, subscribe this channel to get more such information so that you are able to make an educated decision, right? So now coming back to stock market investing, there are two kinds of stock market investing. One is that you invest in individual stocks. By individual stock, I mean you invest in Microsoft, Tesla, Amazon, Nvidia, AMD, you name it, right? But then because you and I are not smart enough, or probably I can talk about myself, I'm not smart enough to understand which is the next Nvidia or which is the next Microsoft, or which is the next Apple, right? People who would have invested in these stocks years back, they are minting money right now. But because you and I cannot decide what a next Amazon or a Tesla or a Microsoft is, there's another strategy for us to follow, which is a very tried and tested strategy, and we'll talk about that. But before coming to the right, what is a stock? Why are people fearful of stocks? Stock is nothing but, it's a piece of the business that you're buying. Let's say I'm buying 10 stocks of Microsoft, right? I'm buying 10 pieces of Microsoft, right? If you think about Microsoft having n number of pieces, I'm just buying 10 small pieces in Microsoft. Of course, that doesn't give me ownership. That's a different discussion for a different day. But the idea is that how do you lose money in stock market? You lose money in stock market when the market goes down. But if you're very smart, if you've done your fundamentals, you've studied everything, you've understood the PE ratio, you've understood what is the product that the company is making, how much future demand that is there in the market for that, which niche is it, is it moat or not? If you've done your due diligence, then a stock is nothing but a piece of the business that you're buying. And then when you make investments, right, you don't buy it today and sell it tomorrow. That's called trading. And I do not do trading myself. And by all means, if you like it, you can do that. I do not do trading and I do not teach trading. I believe in investing for a long time frame, because when you talk about the long time frame, right, that's when you've seen these cycles of ups and downs, and you know that in a longer time frame, if you've invested in a good stock, more than likely you will get good return. Now, coming to the other strategy that I was talking about, right? Let's say you're a full-time employee, or you don't either you don't want to study the individual fundamentals of these companies, or you're not very comfortable, right? Have had a bad experience in past and you don't want to deal with those individual stocks. Then the other strategy, which is pretty much time and tested strategy, is index fund. Index fund, what is an index, right? It's simply a conglomerate of securities, bonds, stocks, whatever you want to call it, right? For example, S&P 500 index, right? S&P 500 index just mirrors your S&P 500 benchmark. So if S&P 500 is up one day, let's say by 1%, right? Then your index fund, which is mirroring the same benchmark, is going to be up by nearly 1%. Same if it goes down, the index is going to go down. So it is basically just mirroring the benchmark, behind which this fund is created. So with buying of an index fund, you're basically buying, those companies that are there in the index. So in simple terms, index is a conglomerate of multiple companies. In this example, we're talking about S&P 500. So S&P 500 is the conglomerate of top US 500 companies, right? So when I'm buying an index, which is benchmarking which is benchmarking S&P 500, I'm basically buying a piece of all these companies. It has got some Tesla, some Microsoft, some Nvidia, some Apple, some part of everything, to the extent that they weigh in this index fund. So there are many benefits of buying an index fund, but the top one that I can talk about is it's purely passive. You are not so think about it, right? You're buying an individual stock one day, and then you are looking up after what is the performance, up or down, where it is. And the market goes down, and you are really panting because you're scared that what will happen to this stock. uh, Today some stocks are investing in AI, which is why they are flourishing like anything. The value is going up, but you don't have control over the individual working of a company, right? You can't decide whether Microsoft decides to take the battleship of AI ahead or not, right? So you can't take those individual decisions for the companies, which is why some people feel very comfortable in investing in index fund, because index fund is basically you don't have the flexibility of keeping certain companies out. Let's say there are certain loss making companies in an index fund, so you don't have the flexibility that you cut down on your losses and you don't want to invest in those companies. No, it comes as a package. But there are many benefits. As I said, the top benefit is it's purely passive. So you don't have to leave your job, leave your work, and plan about which company to invest next, which is the next Amazon, which is the next Tesla. No, you don't have to do that. Buy an index fund, continue to buy that. I'm not saying buy it today and sell it tomorrow. No, it is seen that on a longer time frame, talk about 10 years, 15 years, 20 years, an index fund gives you on an average a 10% year on year ratio. Now if you think you are very smart, you can make far more money than a 10% per year in the long run. By all means, choose your individual stocks, right? I am no one to give you that kind of suggestion or recommendation. But I'm a big fan of passive investing, which is why I heavily invest in index funds. And I believe in the power of time, that, with every paycheck, whatever you can spare, $500, $1,000, just let that money go out and buy the index with whatever price that is on that day. So, biggest benefit is it's purely passive. Second is the money grows in the long term, right? Of course, you're not buying it today with the plan of selling it tomorrow, because in that case, you probably would not make any money, probably even end up losing money depending on where the index is tomorrow. So when you invest, whether that is stock market, whether that is real estate, investment itself means it's a long term. You are parking your money there for a long term. So given that, second benefit is you have long term growth potential in an index fund. As I said, year on year, you can check the numbers. It is nearly about on an average 10%. Now, the third biggest benefit of the index funds is the low expense ratio. So a lot of times you would have heard people saying that, they invested the money in mutual fund and it is down 20%, 30%, and they are cutting their losses and selling it out. Why is that so? Because mutual funds largely are very actively managed funds, which means there is a fund manager who's taking out securities, putting in securities, using their brain behind it. Whereas an index fund is a big conglomerate of many stocks, hundreds of stocks. So it has a self clearing process in itself, that the every year, let us say S&P 500, index itself has a self clearing process that only the top 500 companies will be a part of the index fund. So let us say some company was there in the index today, but next year it's not performing good, it's not one of the top 500 companies, it will automatically be dropped out of that S&P 500. So you don't have to worry about you know whether you have to actively manage your fund or not. It is a very passively invested managed fund, which is why the expense ratio is very low. Now, what is expense ratio, right? Expense ratio is how much you are paying to manage that fund. And because these index funds are not actively managed, you are not paying anybody heavily just to manage those. And if you have not yet subscribed to this channel, please consider subscribing and let me know in your comments below, what do you think about index funds? What is your approach in stock market investment? And what else would you like to learn in upcoming videos? Thank you.